Excellent. Well, let's begin. Welcome, one and all. What we need. Welcome to FX Streets. It's 9 a.m. Eastern. It's Thursday. It's March 22nd. And it is time for a very, very special show. If you folks cannot see the PowerPoint at any point, or if my voice cuts out, please let me know. But without further ado, welcome. My name is Rosen. Thank you to FX Streets. And we have a very, very special show for you today. What we're going to do is discuss a little bit about the basics of the foreign exchange market. So often we tend to get cluttered in our thinking, making things too complicated, applying Fibonacci and Ichimoku and Elliott wave and all these wonderful, more advanced applications, but sometimes I think we miss the basics. So I thought this would be an excellent opportunity. Thank you for FX Street for allowing us to do this, to go ahead and go back to the basics. And of course, if you have any questions, do not hesitate. Type them in at any time. Welcome, by the way, to all my regulars. I love to see everyone here. I recognize so many faces. Well, not the faces, but the names now. Okay, let's get started. I'm going to change a slide. Hopefully that you folks will see the slide change as well. Please let me know. Has a slide changed in front of you? It should say Chapter 1, Introduction to the Forex Market, Fundamental Analysis. Is that, if anyone does not see that, please let me know. You should see. Excellent. Thank you, Boyke. Welcome. Wow. All my regulars. Great. Alrighty. Fundamental analysis of the market. We're going to take a look at the driving forces, the reasons why the foreign exchange market moves. Step number 1. Before we even get into the nuts and bolts, the meat and potatoes of the foreign exchange market, let's discuss trading currencies and pairs. It's unlike any other market. In equity markets, we buy Microsoft. In commodity markets, hopefully, we buy gold or oil. Well, in the foreign exchange market, we are always trading currencies in pairs. You're going to see a currency pair such as the euro-dollar, EUR/USD. Most traders just call it the euro. It's actually the most actively traded currency pair. It represents about half of the total volume in the foreign exchange markets. And when we buy a currency pair like the euro-dollar, it's easy to remember we are always buying the first currency in the pair. In this case, we buy the euro-dollar. Essentially, we're buying euros. What do we do with the dollars? We're selling them. We're selling short the dollars. We're selling the dollars. All this capital we're making, we're taking into our bank account because we sell short the US dollar. Well, we take that money and we buy euros with it. So essentially, we're hoping we're buying the euro dollar. We hope that the euro goes up. We hope that the dollar goes down. If the two happens, or if the euro appreciates faster than the dollar does, or if the dollar declines faster than the euro does, the euro-dollar chart moves up and we make money. It's just that easy. Okay, now how do we make money? Again, we buy the euro-dollar, let's say 145, I wish. 145.00, we buy the euro-dollar. We close the trade, we sell one euro-dollar contract at 146. We've made 100 pips, or in other words, 1 penny. And we've made money. Now, of course, if the market moves against us, then we lose an equal amount. Just to give you an idea, roughly, generally speaking, on trading on one mini lot, every pip is worth roughly $1 US. Every 10 pips is worth $10. Thank you, CVJ, by the way. It's a great point. By the way, on FX Street's website, you will have access to all these PowerPoints. In case anyone is interested afterwards, on FX Street, I don't have the link in front of me. Sometime over the next few hours, if you don't mind, please just post the link on FX Street's website where they can access these PowerPoints. But I don't want to ruin the surprise, so I'm not going to push the link quite yet. Excellent. Thank you very much. Now, the 8 currencies we trade, these are called the G8 currencies. These are the most actively traded currencies. The euro, let me start at the top. The dollar, the Japanese yen, the euro, the pound, the Swiss franc, the Australian dollar, New Zealand dollar, and Canadian dollar. Moving on down. Fundamental forces which move the foreign exchange market. Well, the number one driver of the foreign exchange market is the anticipation, the expectation of higher or lower rates in the near-term future. We expect the Bank of England to cut rates. We see the British pound sell off. we expect the Federal Reserve in the U.S. to one day raise rates, we'll see the U.S. dollar appreciate. Now, it's always the expectation of future rates. The market, as we know it, is a forward-looking mechanism. It doesn't matter where the market is now. We want to know where the market's going to be, right? We know where the euro dollar is trading right now, right? Well, where's the euro dollar going to be an hour from now, or a day from now, or a year from now? That's the real good stuff. That's what we want to know. That's why the market moves in the expectation of higher or lower rates. Now, who adjusts these rates? They're the central banks that govern each respective economy, each respective currency. Why do the central banks cut rates or raise rates? Well, they watch economic indicators. I read at one point that Alan Greenspan, former Fed chief, watched about 200 separate economic indicators. Well, luckily, we don't have to watch that many indicators. We can if you have a lot of free time. But luckily, we just have to watch the central banks. The central banks meet every month, every 6 weeks or so. They adjust interest rates, and they tell us why. They tell us what they're watching. Now, in our premium session, about an hour and a half from now, we're actually going to take a look at the recent central bank statements and try to interpret their Fed speak, as we call it, and try to figure out what they're watching, what the central banks are watching, what the Bank of England or the Federal Open Market Committee, the FOMC in the U.S., is watching in anticipation of what they will do next. I don't know how to pronounce Neds. I hope I pronounced that username correctly. When rates are risen, the markets rise. Absolutely. The market actually moves up in anticipation of higher or lower rates. A very, very good indicators. You read these articles on Bloomberg on the front page, and more often than not, they'll always mention the traders in Chicago in the options floor. And they'll say 45% of the options bets are expecting that the Bank of England will cut rates or the Federal Reserve will cut rates. The last I read was actually during the European session a little bit earlier today. There's anticipation now that the FOMC that meets in June, the Federal Open Market Committee in the U.S., will not cut rates. I think you may see the U.S. dollar continue to appreciate because if the Fed, as we call it, decides we're not going to cut rates anymore, then there's expectation, hey, maybe one day they'll raise rates. They've cut rates a lot over the past couple of years, or the past year or so. Maybe they'll start to raise rates in the future. If the market expects the Fed to raise rates, I think you see the U.S. dollar off of these multi-year lows absolutely explode. Okay, number one driver of the foreign exchange market is the expectation of higher or lower rates. Number two, other large amounts of capital, i.e. commodity markets. Anybody know what crude oil is trading? 135, 235? Oil is a very, very large component of the commodity market and has a very large effect to the foreign exchange market. Now, it has two types of effects. To commodity currency, as we call it, like the Canadian dollar. Canada, by the way, is the number one supplier of oil to the U.S. I believe Saudi Arabia is number 5. Venezuela, Mexico, these are all very large oil producers to the U.S., just as an example, but Canada is number 1. Now, as oil moves higher, well, this benefits the Canadian dollar, but this hurts the more, what we consider the more industrialized economies like the U.S. and Japan. So you can see over the past few years, the dollar, the Japanese yen, a lot of the British pound as well, the euro, they've all been put under varying degrees of pressure when oil rises. But this benefits the Canadian dollar by far. Now, in addition to oil, we have gold, copper, silver, platinum, palladium. These commodities tend to move higher as a hedge towards the following U.S. dollar. U.S. dollar goes down to multi-year lows. Guess what? Gold goes up to a 900. We were almost at 1,000 at one point. Actually, I think a little bit above 1,000. It was really a very tremendous move in the gold and other markets, gold markets, silver markets, and these tend to move up as a hedge towards a falling dollar. Because as the dollar falls, well, those of us that use U.S. dollars these days, unfortunately, right, we lose buying power in the worldwide scheme. So how do we maintain our buying power? Well, if the dollar's falling, we can buy less euros. But guess what? As gold goes up, we can still sell our gold and buy the equivalent amount of euros. That's essentially how it works. You'll notice gold and the euro tend to have a very strong correlation. They both act as a hedge to the U.S. dollar. Gold, and we'll talk about this a little bit later, but gold and the Swiss franc also have a pretty strong correlation. Now, aside from expectation of interest rates and aside from commodity markets, there are also geopolitical events that sometimes occur very unexpectedly. These events, when they occur, and we can think of a couple events in the past, 6, 7, 8 years that have occurred, they trump all other fundamental factors. So even though we may receive a good non-farm payrolls report or a higher than expected CPI, consumer price index report, if unfortunately something geopolitically happens around the world that would affect a certain currency, that takes precedent among everything else. Those are the three, in that order, I would say are the three driving forces. Now, of course, geopolitical events take the #1 role when they do occur. Now, what are the key economic numbers to watch? Please let me know. You should see key economic numbers to watch PowerPoint slide in front of you. The key economic numbers to watch, the #1, in my opinion, are the central bank meetings. The Federal Reserve meets every 6 weeks or so. The European Central Bank, Bank of England, they meet more or less around a month, every month or so on a monthly basis. They decide interest rates. They determine interest rates. The market moves again in expectation. After that, we have non-farm payroll in the U.S., first Friday every month. We have the TIC, the trade in capital flow. That measures the amount of capital going in and out of the U.S. to Japan. The IFO. The IFO number is released in Germany. We just received an IFO number about 28 hours ago in the Eurozone, and that measures Germany in particular, which is considered the most dominant economy or the strongest economy in Europe, at least as far as the currencies are concerned. That is basically an indicator. We're going to talk a lot more about this in detail, but it indicates consumer confidence and business investor confidence. We have the Humphrey Hawkins testimony, which can oftentimes really give us a forward-looking view to the Fed. We have CPI, Consumer Price Index, PPI, Producer Price Index. We have the Philly Fed. We have the ZOO, and we have the Tankin. We're going to discuss these numbers in more detail right now. Central bank meetings. Each nation or group of nations has their own central bank, which sets and adjusts that respective economy's interest rate. Interest rates are raised to control the risk of inflation. When it costs $10 to buy a loaf of bread, it's too much, and they raise interest rates. Interest rates are lowered to stimulate a slowing economy that shows a risk of a slowdown or recession. Now, I'm going to leave this slide up for a second, and I will ask you, the viewers, a very, very important question. We know that interest rates are raised to control inflation. We know interest rates are lowered to stimulate a slowing economy. What would you do if you were in the role of Ben Bernanke or Axel Weber in the ECB, or Jean-Claude Trichet, he's actually the president of the ECB, or the head of the Bank of England, or the head of the Reserve Bank of Australia? What would you do if you had their job and you had a situation where you see rising inflation, I should say, as I struggle with the English language, rising inflation, and at the same time, a slowing economy? CBJ says, indeed, Adam, Humphrey Hawkins' testimony can provide some interesting insight, usually overlooked by most. It's true. I was taught this in my early days on Wall Street, about a decade ago, actually. Feels like yesterday. That the Humphrey Hawkins testimony is a very, very important number, and we should definitely make note of it. But what would you do? I would love, Phil Pre, I love your answer. Were the last two under the Philly Fed? Trader 15, it's a great question. I'm not 100% sure. I don't want to say the wrong answer. Where can we get the Humphrey Hawkins testimony? I don't have a direct link to it. I could tell you to go to the Federal Reserve website. If you go on Google and type in FOMC, Federal Open Market Committee, Humphrey Hawkins testimony, you should be able to get information. It's a very, very widely followed number. I apologize, I don't have the direct link. If somebody has it, somebody's a little ambitious and they have the link to the recent Humphrey Hawkins testimony, please feel free to chat in type in the link. Now, what would you do if you have both problems and you're managing an economy? Well, in the case of the U.S., in the case of the Eurozone, in the case of the Bank of England as well, or the UK, I should say. What do we do when higher inflation? What's inflation? Well, oil at 135 is pretty inflationary. Gold above 900 is pretty inflationary. Anyone who lives in the US or anywhere in Europe or pretty much anywhere in the world would probably not disagree that oil is out of control. And what it costs to fill up a car now, we would not have imagined this is what it costs years ago or a few years ago. I cannot believe that oil was at $25 a barrel in the year 2000 when we were all buying these tech stocks up to $1 gazillion a share. And oil was a sleeping giant. From 25 it went to 135. Ladies and gentlemen, this is not oil.com. It's not a tech stock. This is the oil. It's one of the most stable commodities out there. And it went from 25 to 135 in a matter of, what, 8 years? You know, some stocks don't move at all in the past 8 years. Well, what does the Fed do? What does the Fed do when the higher inflation tells us to raise rates? But if we raise rates, we're already going to kill or put down or weaken a weakening economy. So I guess, you know, I don't know if there's any correct answer. And this is really the quandary. This is the real problem that the Fed, the European Central Bank, the Bank of England are all faced with right now. And as I mentioned in our premium session, we're going to actually read some of these monetary policy statements. For those of you premium members, I really want you to join us. I really hope you join us. It's going to be a very interesting discussion. It's a very tough position, and we're going to compare. Well, the Fed obviously has cut rates because a slowing economy, along with the housing bubble, has really convinced the Fed that they must lower rates. But the Fed is now in a very, very tough situation because now with rates so low and things so inflationary, we run the real risk of higher inflation. Now, Phil Three mentions a very good point. Just blame Greenspan. I don't, but I'll tell you, a lot of people do. And this gives us a very insightful view to Ben Bernanke and what the Fed may do in the future. We read recently on Bloomberg, there's been quite a few articles written about this, how a lot of economists have blamed Greenspan for the housing market, that he kept rates so low too long, that it was too inflationary, and that the housing market, well, not too inflationary, but the interest rates were too low artificially, obviously to help the economy recover, the U.S. economy recover from September 11th, the dot-com bubble, and all the big mess that we faced in 2001. Now, with that said, Greenspan was blamed for the housing market going out of control. Up. Ben Bernanke, now under the microscope of all these economists, many anticipate will not keep rates this low this long. Where are we now on Fed funds rate? Around 2% or so? Well, maybe he's going to start to raise rates faster than expected. Well, notice the words I'm using: anticipation, expected. I personally expect the Fed to start to raise rates, not tomorrow, but sooner than a lot of people most maybe expect. But if I expect the Fed to start raising rates soon, I think the dollar starts to go up. I think you see a recovery in the dollar. Now, in terms of a time frame, I don't think it's going to happen tomorrow, but I think as we come closer to U.S. elections in November, whether it's Hillary, McCain, or Obama, or anyone else, for that matter, I don't think the decision presidentially really matters. I think what matters is that we have some sort of closure. The market doesn't like uncertainty. That when we finally have this closure, that we know who the president is going to be, and that we know that the U.S. economy is not going to zero, and that all of us that own homes are not going to lose our homes, that maybe the U.S. dollar really starts to mount a tremendous rally. Now, here are the respective central banks. In case you like to jot them down, U.S. is governed by the Federal Open Market Committee. We call it the FOMC, or the Fed for short. Eurozone, we call it the ECB, European Central Bank. Bank of England, BOE. The Bank of Japan is the BOJ. The Canadian Bank is the Bank of Canada. Australia is governed by the Reserve Bank of Australia, RBA. New Zealand, RBNZ, Reserve Bank of New Zealand. And the Swiss franc, SNB. Nobody says SNB, though. I haven't heard it. Swiss National Bank is what we say. Let's take a look at some of these economic indicators. Non-farm payroll is one of my favorite economic numbers, and I'll tell you, as we come closer to the election time, I think this is going to become a more and more volatile number. For those of you that have been trading the foreign exchange market for a few years, I remember the days in 2004 as it came closer to the election time. Remember when non-farm payrolls came out less than expected and the euro dollar went up 300 pips within a microsecond? I don't know if we're going to return to that type of volatility. The foreign exchange market has definitely increased in volume, and the volatility, I think, has decreased over the past few years. But I think the non-farm payrolls will start to become a more volatile number as we come closer to the election time. Now, with that said, it's released the first Friday every month. Released by the Bureau of Labor Statistics, provides our unemployment rate currently right around, 5%. Number of non-farm payrolls. Now, last month, remember we received what? It was negative. The expectation was negative 80,000. And the actual number was negative 20,000. It was better than expected. But to put this in perspective, as I run out of breath, as we put this in perspective, in order to maintain a healthy economy in the U.S., the average number we're looking for is approximately 125,000 new jobs every month. Now, we've had 3 months that I recall, maybe 4, of negative non-farm payrolls. It means that the U.S. economy is really expected to slow, as it has. We need to come back up to that 125,000 jobs average. It's like a batting average for those of us that are baseball fans. It's a batting average, and we need to come back up to 125. So far, we've received negative 60, negative 80, most recently, I believe, negative 20. We need to get back above 100, 125. Now, again, it's watched very closely during election years because unemployment becomes a very popular issue to discuss. It's considered, by the way, one of the most timely and broadest indicators of the U.S. economy. Number 2, the TIC, Treasury International Capital System. It's released on the 11th business day of each month, and it measures trade flow and capital flow in and out of a particular country and or currency. Now, we can classify each currency, the Euro, Pound, Swiss, Aussie, Kiwi, CAD, Dollar, Yen. We can classify each of these 8 currencies into either trade flow or capital flow. Just take a step back and think about how that respective economy tends to benefit. Well, the U.S. economy is considered a very good example of capital flow because a lot of nations and a lot of investors invest their capital into the U.S. economy when things look good. One great example is Japan. This is why the dollar-yen has such strong correlation, strong association to the Dow Jones Industrial Average. Because keep in mind, the Japanese yen has very low rates, lower than any of the other currencies that we watch. So Japanese investors get very bored with 0.5% interest rates, and they say, hey, the U.S. economy looks good. Let's put our capital in the U.S. economy. Well, they put into the U.S. economy, they buy U.S. stocks, they invest, merger acquisition, things of that nature. But when things look bad, i.e. housing markets and recessions, they pull capital out of the U.S. economy, out of the Dow Jones Industrial Average, which sends that index lower, and places it back inside the Japanese yen. And that's why when the Dow goes down, the dollar yen tends to go down. CVJ, exactly. I'm a fine reminder here that the non-farm payroll is released. Ebb and flow, important impact over the time. Remember all the massive colors, minimal importance. Now we're seeing down. Yeah, you're absolutely right. CVJ, it's an excellent point. I'll tell you why else. I completely agree with you, and I'm going to add to this. I see your comment, and I raise you a comment. I'll tell you exactly why. The Fed has been cutting rates and cutting rates and cutting rates, okay? We have come to a point now, the Fed has said, we don't want to cut rates anymore. There's a risk of inflation, and that maybe we're going to raise rates in the future. We're probably not going to cut rates. Now, what we are going to do is watch the Fed very closely. Now, what is the Fed watching? The Fed is watching economic numbers. The Fed has put the markets in the hands of the non-farm payrolls. The Fed is saying, hey, we don't know what we're going to do yet. We're going to watch non-farm payrolls. We don't know what we're going to do yet. We're watching CPI. Now, they don't mention the economic indicators, but they mention words like inflation, growth, housing markets, things of this nature. So with that said, the Fed and other central banks, the European Central Bank has done this too. They have said, we're going to watch our growth over the next 4 to 6 weeks, and we'll make our decision at that point. Well, that tells us, the average, average Joe trader like myself, hey, well, the Fed's not telling me what they're going to do. They're telling me to watch non-farm payrolls. They're telling me to watch CPI numbers and tick numbers. That has put the market in the hands of these economic indicators, and that's why, in my opinion, I think these economic indicators, as mentioned very, very wisely by CBJ, I think these economic indicators will begin and already have begun to play a more important role in the foreign exchange market, and will begin to become more volatile as well. These slides absolutely will be available later on, and we are recording the session as well. So I promise we will give you links to these PowerPoints, as well. FX Street will provide you with a link to this recorded session as well. Do not fear. Excellent point. What about housing? Well, housing is a very, very big number too. The Treasury International Capital System, or Treasury International Capital System, as I had it right the first time, affects mostly the dollar-yen pair. I would say the dollar-yen is the primary instrument. Just really quickly, testing, by the way, the audio really quick. I want to make sure that you folks can hear me. I want to make sure that my volume is loud enough. If you can't hear me, please do try to turn up the volume on your end. I want to try to get it more or less as even as possible for most. Excellent, excellent. Thank you very much. Okay, about the down S&P and bonds, 10-year, how does this correlate with the U.S. currency, Japanese and other pairs? Canadians, excellent, excellent question. Thank you very much, everybody, by the way, for letting me know. Okay, the Dow Jones Industrial Average, I think, has the strongest correlation. I was told by somebody at one point there's a 95% correlation. I wouldn't necessarily say 95, but there's a very, very strong correlation with the Dow. Now, obviously, there's a strong correlation with the Dow and the S&P 500. The Dow Jones Industrial Average measures those companies, the Citigroups, American Express, General Motors, Ford, the big industrialized names that represent I would say the most accurate representation of the U.S. economy. The S&P 500 involves a lot more tech stocks, and it tends to be a little bit more volatile. I would say the S&P 500 tends to move above and below the Dow Jones Industrial Average with a greater amount of volatility. I know the Dow has the strongest correlation to the dollar-yen pair. As far as 10-year bonds, excellent question as well. Well, we know. Why do bond markets rise and fall? Well, the bond goes up and the yield goes down. That's essentially the easiest way to say it. When the stock market looks bad and things look bad, we take our capital out of the stock market. Things don't look good. Let's run for the hills. Let's put our capital into something safe. Let's buy bonds. We buy the 10-year U.S. bond. Beautiful. Okay, the 10-year U.S. bond, we buy it. The price of the bond goes up. The yield goes down. So the yield goes down when the price of the bond goes up. When the price of the bond goes down, when things look good, we sell bonds. The bond market has to offer us a higher yield to compete with the strong Dow Jones Industrial Average. So essentially the yield of the 10-year bond and the Dow Jones Industrial Average and the dollar-yen all tend to move in the same direction. Essentially, dollar-yen goes up, Dow Jones Industrial Average goes up, and the yield goes up. So bonds go up and the yen goes down. Absolutely. And it's a very, very important relationship. I would say probably one of the most important relationships in all the foreign exchange market is the dollar and the yen. Not to take anything away from the euro, but it is a very important factor. Now, again, just really quickly wrapping up the tick. I love these questions, by the way. Please keep them coming. It measures trade flow and capital flow in that particular country or currency. We know the U.S. is a capital flow intensive economy, because capital is invested in the U.S. when things look good. Japan is a trade flow because they benefit from trade. The U.S. has the #1 relationship consumer-producer to Japan. So when things look good and the U.S. consumer buys automobiles from Japan, this inevitably benefits the Japanese yen. Now, it's a reporting system that's responsible for tracking international capital movements and investments. Information is collected from commercial banks, broker-dealers, financial institutions, you name it. Did I answer your question, Trader 15? So when bonds go up, the yield goes down. and the dollar yen goes down, which means the yen goes up. So you are correct. So when the bond price goes up, the Japanese yen goes up. But I think the easiest way to think about this is this way. Start with I want to make sure I didn't go too far. No, we didn't. Think of it, start with the Dow Jones Industrial Average. We had a good day in the Dow. Hey, things look good. Japanese investors that are a little bit bored with 0.5% interest rate in the yen say, hey, things look good in the U.S. Let's buy some stocks. They buy some stocks, the Dow goes up. Well, capital coming out of Japan, out of the yen, into the dollar, selling yen, buying dollar, the dollar yen goes up. That's essentially, and of course, when the Dow goes up, we sell bonds. When we sell bonds, the yield goes up because the bond market has to give us a yield that is interesting. It has to compete. The next on our list, the IFO. We just received this number about 28, 29 hours ago, maybe a little bit more than that. It's a business survey conducted monthly, asks around 7,000 companies throughout Germany 2 specific questions. How business is performing right now in Germany, and how is business expected to perform over the next 6 months? It's a pretty short-term indicator. It's a monthly business survey. It's one of the main surveys of enterprises of manufacturing, construction, retailing, and wholesale. The survey results published monthly by the European Commission indicates economic prosperity in the Eurozone. It can be a very, very important number to watch. I don't want to sound like a broken record. All of the numbers we mentioned here are very important numbers to watch. But the IFO can be a tradable number. We can trade the non-farm payrolls. We can trade the IFO number. Hopefully, if we have some time, I want to take you through some of these trading strategies as well. Well, here's a little bit more about the Humphrey Hawkins testimony. They meet every February and July to discuss monetary policy. That means the Fed raising and lowering rates. The financial markets take great interest in the Federal Reserve Chairman's Humphrey Hawkins addresses, looking to it for hints about the future Federal Reserve policy. Federal Reserve considers 6 basic goals. This is what consists of the Humphrey Hawkins testimony. Economic growth, high employment, high employment, price stability, interest rate stability, stability in the financial markets. Remember all that credit crisis we went through? They talked about that in the Humphrey Hawkins testimony. And stability in the foreign exchange markets. Not only does the U.S. and many other economies not like a falling U.S. dollar, but this volatility, they say, has got to stop. They don't like the volatility because it becomes much, much more difficult for corporations that use currencies to hedge their operations overseas. You know, think of it this way. You work for Microsoft and you open a plant in Europe or in South America or wherever it may be, and you see not only is the dollar falling, so hey, we have to buy some euros because we have to pay our European employees, right? Well, more than that, the euro dollar goes up and down several hundred pips a week. How do we hedge ourselves? That's the tough part. Phil Free, the true trader, says, but without volatility, we can't make money. Who cares about the Humphrey Hawkins? I want to make money. It's an excellent point, though. There are ways to make money without volatility, relying more on the overall trend, relying on what we call the carry trade, where we gain interest from one currency to the other. But you are right, Phil Free. We need the volatility. The volatility is what pays the bills. When things look bad for our economy, do the Japanese also buy our bonds when they dump these equities? It's a great question. You know, I think there's 2 answers, Trader 15. Oh, you guys, ladies and gentlemen, are really pushing me to the test today. I love it. When things look bad for our economy, do the Japanese also buy our bonds? I would say generally yes. When they sell equities, generally the reaction is to buy bonds or just to get out of the U.S. markets altogether. I would say when things look really bad, they sell the stocks and buy Japanese yen. But when things look moderately weak, but they still have faith in the U.S. economy, I don't mean they, meaning necessarily Japan, it's really every one of us. Every one of us that sold the euro-yen or the dollar-yen pair is participating one way or the other in this phenomenon. So I would say when things look really, really bad, I would say maybe more capital comes out of the U.S. altogether and moves into Japanese yen. But generally speaking, I would say that the strongest relationship or the strongest phenomenon that happens is when the stock market goes down, the dollar goes down, and capital goes back either into the yen or into the bond market. I don't know if there's an equal relationship. It's a pretty consistent relationship, though. Surprised with the USA because if it would be a business, it would be bankrupt. Boyke, you hit the nail on the head. But, you know, thank goodness that we have reserves. We have the bad times and we have the good times. But as traders, you know what? If we think the currency goes up, let's buy it. If we think it's going to go down, let's sell it. There's always another trading day. Here's another important number. We saw this number released last week on a couple different currencies, the CPI, Consumer Price Index. Now, when the Fed or the Bank of England talks about inflation, they talk about the Consumer Price Index. It's released on a monthly basis, also known as the Cost of Living Index. It's an inflationary indicator that measures a change in cost of a fixed basket of products and services, including housing, electricity, that's inflationary. Food, that's inflationary. Transportation, that's inflationary. Perhaps another way to state Philippe's point is we really need liquidity, not necessarily volatility, the two sisters, if you will. DBJ, I agree with you. You guys are all right on the ball. Liquidity, I don't necessarily think is a tremendous problem if we stick to the 8 major currencies. I don't know if anyone that's traded the dollar yen says, hey, I can't get executed. If you're having trouble getting executed on the dollar yen or the euro dollar, I think you're trading too big. No, I'm kidding around. But in terms of volatility, yeah, the volatility is can be a double-edged sword, and it's a really tough. It's a tough side of the market to get our hands around. Sometimes we get used to low volatility markets. We play the range, and then all of a sudden we break out. In regards to the CPI, we should watch a CPI because it definitely indicates what the consumer is paying for the average basket of goods and services. Now, the PPI comes before the CPI. I should reverse these 2 slides. It is the Producer Price Index, also updated on a monthly basis. It's a government index that measures the prices of goods at the wholesale level. Now, the market tracks the finished goods index most closely as it represents prices for goods that are ready for sale to the end user. At all stages of production, the market places more emphasis on the core rates. When they're released, they will always give you the core rate and the PPI excluding food, right? Food and energy. The core rate takes away food and energy because they're considered to be more volatile components of the market, and therefore it tends to skew the number. So focus on the core rate of the PPI. Food and energy prices, again, tend to be quite volatile and obscure trends in the underlying inflation rates. Well, if we take away food and energy, maybe inflation isn't that bad. Maybe the Fed doesn't have to raise rates. If we disregard oil, if we disregard food prices as well. The PPI, when it's higher than expected, it is expected that they will pass on their extra burden to the consumer. Going down to the basic mom-and-pop pizza shop. They buy cheese. Hey, that's food. That's inflationary. They buy bread. They spend money on fuel to make these big ovens that make these pizzas all day. If it costs more to make a slice of pizza, then the price of a slice of pizza is going to go up to the consumer. And this is, I think, the best way to explain the relationship with the PPI to the CPI. If it costs the producer more, inevitably will cost the consumer more. Let's talk about, look who likes pizzas, right? Talk to the New Yorker. Philly Fed, released every month. Index based on one of several regional manufacturing reports. It's released monthly. The National Association of Purchasing Managers, NAPM Index. 50% marks the break-even line between expanding and contracting manufacturing sector. Above 50 is good, below 50 is bad. Now, the Philly Fed survey can be some help in forecasting the national NAPM due to its timeliness and the fact that this region represents a reasonable cross-section of the national manufacturing activities. And again, above 50 is good, below 50 is bad, and it focuses on manufacturing. The ZOO, this is another European number which is very important. Released also on a monthly basis, most of these numbers are. Economic Sentiment Survey, measures European investor confidence. Now, it's compiled by the ZOO Research Institute. Please do not ask me what ZOO stands for. I believe it's German. I do not know. I could find it for you. I could not pronounce it for you, though. It's based on the survey of analysts and institutional investors. It gauges the overall consensus and expectations of future Eurozone economic performance. It's investor confidence in the Eurozone. The Tenkan. Finally, we get to Japan. The survey is conducted quarterly in March, June, September, and December. Hey, we have a Tenkan number coming up soon. The survey is conducted to provide an accurate picture of business trends of enterprises in Japan. Notice how all these indicators tend to focus on manufacturing, inflation, business enterprises. These are the main components of the economies that the Fed and the other, thank you very much, by the way, Google. Thank you very much. That is, I can't pronounce it for you. I will not even try. But that link provides you with the Zoom. And this Tenkan number is very, very important in terms of Japan. It measures the economic sentiment among the various Japanese businesses in regard to the following topics: employment conditions, business conditions, supply and demand conditions for products and services, the lending attitude of financial institutions. Remember how the credit crisis, these lenders were raising rates through the roof. Overseas supply and demand conditions for products. Remember, Japan is also a very trade centralized economy. They need trade in order to maintain the economy. So it does watch also overseas supply and demand conditions for products. Now let's talk a little bit about the commodity market. Commodities, oil, benefits again Canada to number one supplier. They are the number one supplier of crude oil to the U.S. It places pressure on the industrialized based economies such as the U.S., Europe, and Japan. Gold and other precious metals, i.e. silver, copper, palladium, platinum, benefits the Swiss franc. The Swiss franc for the longest time had a very strong correlation with the price of gold. It has detached to an extent. There's been a little bit of a decoupling, but still, if you plot the Swiss franc and the price of gold on one chart, you'll see a very strong correlation as capital is placed into Switzerland, and a lot of it is found in gold. It also benefits Australia and New Zealand. Now, guess where a lot of metals come from? Australia. It's actually one of the largest producers of gold and other metals, copper, silver as well. New Zealand, I like to consider a little bit more of a soft economy, wheat, farming products, things of that nature, but still has a very strong correlation to the commodity market. And of course, these metals act as a hedge to a falling U.S. dollar and a hedge to inflation. As things get more expensive, the U.S. dollar, just as an example, tends to lose its buying power. So we buy gold and other metals to preserve our buying power. Now, I mentioned this before, geopolitical events, expected and unexpected, can play a very large role in the foreign exchange market. This can include elections, national strikes, embargoes, wartime activity, you name it. So we should always be aware. So in conclusion, we're not done, I promise you that, but in conclusion of this piece of the presentation, in terms of the economic, I should say the fundamental side of the foreign exchange market, the number one driver of the foreign exchange market is higher or lower interest rates. Number two are the commodity markets. And number three, sometimes number one, are these geopolitical events. In terms of the fundamental analysis, what we should watch, well, these again are the big numbers that we should watch. Central bank meetings, non-farm payroll, the tick number, the IFO, Humphrey, Hawkins, CPI, PPI, Philly Fed, the ZOO, and the Tenkan. Now, if you will bear with me, less than 10 seconds. I promise you, it won't be long now. We have another very, very exciting segment for you. Voila. Please let me know if you cannot see this. You should see a slide entitled Chapter 2, Chart Reading Made Easy. We've made this chart reading made very easy. Please let me know if you cannot see this, but you should be okay. Excellent. Thank you very much. Now, we have a fundamental opinion of the markets. I think the dollar goes up long term. I think the Fed is done cutting rates. I think the Bank of England is going to cut rates in June. I think they're going to continue to cut rates. I think the Fed has been ahead of the curve. Please take my opinion with a grain of salt. It's just mine. But if I think the Fed is done cutting rates and they may start to raise rates sometime in the future, if I think the Bank of England will continue to cut rates, I think the dollar goes up. I think the British pound goes down. I think the pound dollar is a short. Where do I sell? How much do I sell? Where do I place my stop order? Where do I take profits? All these answers, I do not believe fundamental analysis can answer these questions. Technical analysis can. Technical analysis is the science and the art of analyzing price charts to look for particular trends and market tendencies. We place our trade with the anticipation the recent market behavior will continue to persist in the near-term future. Here is a picture of an uptrending market. This is the pound dollar. I took this picture not too long ago. Look at the pound at 204. Wish I would have sold short there, right? Well, we draw supports at the bottom by connecting significant lows. We draw resistance by connecting the significant highs. I believe the next slide actually shows you a downtrending market. This is a downtrending market. Now, in uptrending markets, support or the floor is more important. I'll tell you why in a moment. In a downtrending market, resistance or the ceiling is more important. Here's a range-bound market. When the market fails to make new highs or new lows, we have a range-bound market. You ever see a triangle pattern? That's a range-bound market. A head and shoulders? That's also a range-bound market. Sometimes range-bound markets have flat supports at the bottom and flat resistance at the top. Sometimes they're inclining, sometimes they're declining, but the easiest way to classify the two is a previous slide is a trending market. It tends to make new highs or new lows. A range-bound market does not make new highs or new lows. Now, it is true we can have range-bound markets on a 1-hour chart and have a trending market on a daily chart. We must make a decision, each of us as a trader. Do we want to trade long-term? Then we use daily charts. Do we want to trade medium-term, short-term, maybe 1-hour charts? But we should trade the market that we have in front of us. Here's another picture of a range-bound market. Very, very simple, pound-yen. Not a very typical range-bound pair, but at the moment it was. And in range-bound markets, we want to adopt a very simple buy low, sell high approach. And this is what I meant when we just mentioned. We want to place a trade with the anticipation that the market will continue to behave as it has recently. We see support right now around 230, if you see the figure on the chart. Resistance around 234. The next time pound yen, according to this chart, comes down to 230, tests this level, fails to go below it, and then starts going back up, I want to buy. Next time we go to 234 and fail to go above and then go back down, I want to sell shorts. Taking profits, well, probably in the middle. Here's another picture of a range-bound market. Whoop, that was the same picture. Okay. And here's a head and shoulders. Everybody hear about a head and shoulders? It is essentially a range-bound market that is broken. It's also considered a triple top. Now, a triple top, where the center top, the center high, is higher than the first or the second. The first shoulder, the market rallies to a high. The buyers say, great, we went all the way up. I'm looking at the chart over here. This is the dollar Swiss. We went all the way to 125.83. Beautiful. We came back down to what we know as a shoulder line. Then we rallied up. We made higher highs. Now this tells us the market's trending higher. Beautiful. Well, there's a very important precedent in technical analysis. If our resistance, our ceiling, that line of the first shoulder is broken, it should become our new support. This was trouble. When the market crossed back below the high of the first shoulder, the market failed to hold new highs. This told us we're in trouble. We came back down to the shoulder line again. We should ask ourselves, hey, if the market was able to make higher highs, how come the market was not able to make higher lows? Now, the second time the market comes back up and tests now the second shoulder, which generally lies near the high of the first shoulder, then we should really be nervous. I want to close all my long positions, all my buy orders I want to get rid of, because now, if the market has made a similar low and now fails to make a new high, or at least go back up to the highs of the head, then I want to sell short right here. Right near the highs of the first shoulder should be the second shoulder. I want to sell short. I want to place my protective stops above the highs of the first and second shoulder, and typically head and shoulders will break in the opposite direction of the head. In this case, the head's on the top. Sometimes we have an upside down head and shoulder where the head's at the bottom. This is like somebody hanging from their feet. We see the first shoulder of the market goes down to 111.71 on the dollar Swiss 4-hour chart. Then goes down, makes a head all the way to the bottom at 108.90. Then rallies back up at, hey, we made a lower low. How come we didn't make a lower high? We went all the way back up to 113. Uh-oh. Here's the second shoulder. Look at this. The market fails to cross back below, cannot even reaccomplish the lows of the head. At this point, we go long, 111.71. We place our stops below the lows of the second shoulder, below the lows of the first shoulder, and we sit there and hold tight. And we see from 111.71, we rally to 115 just in a matter of days. Not a bad trade at all. And this is a very, very common pattern. Here's a double top, even more common. This simply occurs when the market hits the same price level at least twice and then reverses course. Now, the market may be going up, 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 up. Let's say I bought the, Aussie dollar pair. The market goes up. When do I take profits? Do I take profit here or later or later? I personally like to wait for the market to accomplish a double top before I want to close my long position. I think the market has continued strength, continued potential to the upside. But if the market tests and fails to break above a specific price level, oftentimes are the large round figures, 116.00, 117.00, 118.50, like this, the big numbers. If we fail to break above a certain big number twice, then I want to be on the lookout for a reversal, which is exactly what happened here. Here's a double top and a double bottom, a series of double tops and bottoms. This is what occurs when we have a range-bound market. Double top, a top, a bottom. Actually, a little bit of a double top right over here at June 26th, and a bottom. Well, the anticipation of the second top, we wait for it, then we wait for the reversal. Now we sell short, we place our stops above the highs of the both tops. We sell short, we see the market comes down. Hey, guess what? Double bottom. Close our long trade, open a short, close our short trade, open a long trade. Ideally, in range-bound markets, I like to take profits in the middle of the range. We don't always know the market will really come all the way up to support, resistance, or all the way down to supports. Now, here's an ascending triangle, another very common pattern. This is a range-bound market. It turns into a trending market. Notice how the uptrending support continues to climb higher and higher and higher, and the sellers say, hey, this is around 133.80 roughly. The sellers say, we're going to stay here, we're going to stay here. But the buyers are continuing to become more and more aggressive. These trend lines, I think, are very, very crucial because it shows us the angle of the trend line, shows us the relationship of the buyers to the sellers. The buyers are getting stronger while the sellers are staying put over the same period of time. Well, eventually the buyers and sellers will meet on the same battlefield, the same price level, and one side will win. In this case, the buyers continue to make money, and the shorts got squeezed out, had to cover their trades, had to buy back their positions. Maybe some stop orders were included, maybe some margin calls. Unfortunately, it does occur from time to time. And the next thing you know, we have a breakout. Here's a descending triangle, opposite scenario. The sellers are getting stronger and stronger and stronger. The buyer said, hey, 113.26 is good enough for me. I'm not buying it any higher. And again, a test, and then we broke down. In this case, as soon as we make a new low, all the buyers are losing money, all the sellers are making money, and the market becomes directional. Here's a symmetrical triangle, a little bit more difficult to analyze because the buyers and sellers are relatively even in their strength. Now, overall, personal observation, I've noticed that triangles have the tendency to break out in the same direction as the overall trend. So if you see a long-term trend on the daily charts, and then you go to a 1-hour chart and you see a triangle occurring, maybe on the Aussie dollar right now, maybe on the Euro dollar right now, I have personally noticed that triangles tend to break out in the same direction as the overall trend. Final thoughts in terms of our chart reading basics. Begin with the long-term charts. Identify the major support and resistance levels. I cannot say this enough. The trend is your friend. Now, avoid anticipating the breakout that has not occurred yet. Don't buy a price until the market gets there. Remember, We want to wait for resistance to be broken before we buy at that new support. We don't want to sell short anticipating the support will be broken. We want to wait for support to be broken and then sell short when the support acts as our new resistance. Wait for the trade, the best possible entry. Entry really is everything. It gives us a very, very good risk-reward ratio. We'll talk about this a little bit later on in our presentation. We have more time. Excellent. If you have any questions, please do not hesitate. Let us see here. I don't want to run out of time, so I'm going to jump forward. If I have time, I'm going to go back. But I want to talk about money management. I know it's a little boring, but I tell you, I think it's the most important area of trading. Money management. Please let me know if you cannot see this. It should say Chapter 3, Money Management Discussion and Additional Trading Tips. Now, how much do we buy? How much should I risk in each trade? If we open up a $300 mini account, should we bet the whole wad on one trade? If I open up a $10,000 standard account, should I bet the whole account on one trade? Well, the answer is no. We should limit our risk per trade to a very small percentage of our current account balance. I recommend no more than 5%. We open up a $10,000 account, well, 5% of that is $500. I do not want to lose more than $500 on each individual trade, given our current account balance or equity is $10,000. Now the risk, how do we measure risk? It's determined as the distance from the entry to the protective stop order multiplied by the trade time. So we buy one mini lot of the euro dollar at 145.00. We place our stop order at 144.00. We've risked 100 pips. Well, one mini lot, 100 pips is $100. On a standard lot, 100K, that would be $1,000. So in the case of a $10,000 account, we want to risk no more than 5% of that. Well, 5% of 10,000 is 500. We want to risk on a 100 pip stop. How many mini lots can we trade? The first one that types in the correct answer receives a round of applause. It is indeed unfortunate. Money management, risk management is so often overlooked. We say emotional stability, treaties, ILA. If we have a $10,000 account, and I know this is simple, I know everybody knows the answer, but how come we don't follow the answers? How come we don't follow the rules? I'm talking to myself as well. We should apply very, very strict money management. You may use Ichimoku. I may use Fibonacci. That's okay with me. You may use moving averages. I may use trend lines. That's okay with me. But money management, it determines the survival of our accounts. I do not want to risk more than 5% is the absolute maximum. It's tough, I know, if you have a $300 mini account, how do I risk only, I don't know, $15? 15 pip stops are not enough. Now, $300 mini account, it's good to get your feet wet, you know, but really, if you want to open up an account with a decent amount, you know, thousands of dollars or more, apply strict money management. 5% is a lot, actually. Feel free. You are correct. 5% is the maximum. I would tell you, if your account, if you have enough money in the account, start with 1 or 2%. You have a $10,000 account. If you lose $200 and your account equity is $9,800, that's not nice. It's not the end of the world. But how often have we opened a $5,000 account, placed 6 trades, and all of a sudden the $5,000 account is $1,900, right? And we said, oh, I just need to, now we're thinking to ourselves, not about the charts, we're not thinking about the Bank of England, about monetary policy. We're saying to ourselves the same exact thing. How do I get the 1,900 back up to 5,000? Double down, right? Feel free. That's the wrong answer. I love it though. Double down. This is not, I want to save that type of trading for the casino, right? That's the slot machine. Double down. No, in terms of, look, if we want to manage the accounts in the right way, if we want to give the account the best potential of making money over the long term, we want to trade in the most proficient manner possible. And, you know, a lot of traders will ask me, well, you know, how do the banks trade? Well, you know, you work at like JP Morgan, Chase Manhattan, or, you know, Bank of America or Citigroup. These foreign exchange traders are probably in charge of less than 1% to 1% to 1% of Citigroup's equity. You know, that's why if a trader blows up and gets fired, Citigroup stock doesn't even go down a penny. Now, Boyke mentions a very important point. How about leverage? Well, leverage can change. We can use 400 to 1 leverage. We can use 50 to 1 leverage. But I like to approach money management in terms of how much am I risking from my entry to my stop, okay, 100 pips, multiplied by my position size. One mini lot, 100 pips, that's $100. Now, we can use 400 to 1 leverage, and that means that one mini lot will only require us to put down $25 in margin. We can use 50 to 1 leverage, and that would require, $200 in margin. So obviously, I like to use the highest leverage possible. $25 to control 10,000 euro dollar is better for me. But you know what? If we're using the right money management, the leverage really is not going to make a big difference. We can use 50 to 1, we can use 400 to 1, or anything in between. As long as we maintain that from the entry to the stop, multiplied by our position size is not going to risk worst case scenario. Plan for the worst, hope for the best. That the worst case scenario, if the market hits our stop order, our account won't go down more than 5%. And if our trader assumes more than risk tolerable, we must either reduce our position size or wait for a better entry that does not include moving our stop order up. If we buy at 145 and we say, hey, I want to buy 10 standard lots, I'm going to put my stop at 144.89. And therefore, if I get stopped out, I'll only risk 5%. Well, we have to place our protective stops in terms of what the charts tell us. We have to place our stops below supports and above resistance. The market doesn't care how much leverage we use. I've made the same mistake as well. Believe me. I say, hey, well, I can buy 5 standard lots here, and I'll use an 8-pip stop, and that way I won't risk more than 5%. But what's the likelihood of getting stopped out with an 8-pip stop? Pretty high. Pretty high indeed. What is a risk-to-reward ratio? We mentioned this before. A risk-reward ratio is a risk taken to the potential reward. Now, generally speaking, I would say this. I do not like to take trades with less than a 3 to 1 risk-reward ratio. Some traders say 1 to 3, 3 to 1. It's semantics. But I'll explain how it works. Buy one contract of the euro dollar at 145. We place a protective stop at 144. We place our limit order to take profits at 148. Our potential risk is $100 on the mini lot, 100 pips. Our potential reward is 300. 3 to 1. 300 potential profits, 100 potential risk, 3 to 1. Now, if you really read into the risk reward, the word risk comes first, so you would call it a 1 to 3. But a 1 to 3 or 3 to 1, however we call it, we want to make sure that each one of our trades has potential to make at least 3 times our risk. Think of it this way. We open up an account, we place 10 trades with a 3 to 1 risk reward ratio. Now, let's say we're only 50% accurate. Well, 50% accurate in baseball is pretty good, but not in trading. But anyway, we're 50% right. 5 of our trades, we make $300. We've made $1,500. Great. On 5 of our trades, we lose $100. We've lost $500. Therefore, we've made $1,500. We've lost $500. Overall, we've made $1,000. Not too bad at all. Batting at a 50% average, we've made $1,000. Okay, on trading on one mini lot. Okay. Now, if we use a 1 to 1 risk reward ratio, where we try to make 100 pips and risk 100 pips, all of a sudden that 50% batting average is not so good anymore. We make 500, we lose 500, the accounts break even, and we probably went through a lot of emotional heartbreak watching the account equity go up and down, profitable, negative, profitable, negative. Now, how do we determine where to place our limit order, where to get in, where to place our stop order? These questions are all answered by looking at the charts. We draw support, we draw resistance. I want to buy just above supports. I want to sell short just below resistance, always keeping in mind the overall trend, trade with the trend, and place your stops below support, place our stops above resistance, but we want to make sure, and the entry really helps. The entry helps us get a better risk-reward ratio. Now, how do we measure overall portfolio risk? Always note any relationships between various currency pairs when trading multiple positions. If we buy one euro dollar contract and one pound dollar contract, our net exposure, we're long 1 euro, we're long 1 pound, we're short 2 US dollars. If the dollar starts to rally, both of our trades will lose money. That's easy. Now, note the tendency of each currency under specific economic/geopolitical conditions. Commodity markets move higher. This may benefit Canadian dollar, i.e. oil, the Aussie, the Kiwi, the Swissy, metals. Crude oil rises. This may weaken the dollar, the yen, the euro, or the pound. So especially with crude oil going through the roof over here, even though we're not trading the dollar CAD or the CAD yen pair or the pound CAD, let's say we're trading the Aussie pound, crude oil rises. This invariably could hurt. Is it the pound Aussie, I should say? This could hurt. So we should measure our portfolio risk taking this into consideration. Foreign exchange market, it's all connected. It really is all connected. Now, I recommend this wholeheartedly. Write a trading plan. What is my arsenal of my trading strategies? Do we use the RSI indicator? Do we use the Bollinger Bands? We should write down on a piece of paper, and we should take this to our desk where the computer is. What are the rules for me to get in and me to get out of a trade? A trader I used to work with a long time ago gave me a piece of advice. At the time, it didn't sound like good advice, but it proved to be very, very helpful. He says the reason you get in a trade is the reason you get out of a trade. I should know before I get an in or out, why am I getting in or out based on the charts, and I'm not allowed to change the time frame. How often have we bought based on a 5-minute chart and said, hey, the euro dollar looks good in a 5-minute chart, it's going up, right? Then it starts to go down. Say, uh-oh, I don't feel so good. Let me go to a 1-hour chart and say, hey, 1-hour chart looks great. I have support coming up. It's only 90 pips lower. All of a sudden, our day trade, which we had the intention to take 5, 10, 20 pip profits, now this has turned into an investment, a longer-term trade. So what happens? All of our day trades that we make money, we make 20 pips. But all of a sudden, we're moving our stop orders down. We're allowing ourselves to lose 90 pips or 100 pips or more. That's not good. That is a pure recipe for disaster. I'm telling you from my own personal experience. What kind of trader am I? How long should I hold each position for? Am I long-term? Then I use daily charts and weekly charts. I love long-term trading. I think it's the best way to go in the foreign exchange market. I know it's boring, but I really believe that. Medium-term, 1-hour and 4-hour charts, we call these swing traders. They hold positions for a few hours to a few days, maybe a week at a time. Then we have the short-term guys. Like myself, I used to be a short-term day trader. When I traded equities, believe it or not, I sometimes would trade 100 to 200 trades a day. It's too much for any person to maintain their sanity. Day traders usually have a very short career expectancy, 2 to 3 years, and then you start looking for open windows. It's not the way I would go, especially in the foreign exchange market, because the market never closes. We don't really have that kind of risk of a stock closing at 50 and opening at 5. We don't have the risk of a gap. Market's fluid. Am I a scalper? Scalper, I think it's pretty much synonymous with short-term trading or day trading. Scalping, I think, is the term I first heard when I was trading stocks. And people would say, I scalped 10 pennies off of this one, 10 cents off of this one, I scalped 15 cents. It just basically means, and I don't know if scalping necessarily even can be applied. To be quite honest with you, I don't think it can be applied to foreign exchange market. If you're a stock trader, this is going back a few years before the decimals, before there was so much program trading in the equity markets, you would be able to read the tape, as I say, a lot better. You'd have the bid, you'd have the offer, and you'd see the market come down, you'd see the volume increase, you'd see the specialist on the New York Stock Exchange stocks. He would print a very, very large order, and then you would see that the market probably had a good chance of bottoming out there, and it would bounce back up about 15 cents. And we'd buy at the bottom, scalp above 15 cents, and we'd say, yeah, I scalped about a dime out of it. I scalped a quarter out of it. That's typically a very short-term day trading type of approach. Can one be all three? Long-term, short-term, medium-term? I think it's very, very difficult to be. Now, I would say this. If you think the Aussie dollar, okay, better example, pound dollar. I think pound dollar is a fantastic short fundamentally down. I've been right and I've been wrong. Recently I've been wrong because the pound dollar recently just exploded. But I take my lumps like the best of them. I think the pound dollar long term goes down. I'm waiting and I'm hoping the pound dollar gets up to a level probably between 198 to double parity, 2.0000. I'm only using long-term charts in the pound dollar. I'm not interested in scalping. I would love to sell short the pound dollar, take a nice position size, obviously not too big for my own wallet, and just take a short in the pound dollar and hold on for dear life. I think the pound dollar, fundamentally, I think it goes down a lot. Okay? So in that case, the pound dollar, I refuse to take any short-term trades. I don't want to look at any short-term charts. I just like the pound dollar long-term down. Okay? Now, if I can do that and at the same time maintain my sanity and scalp or take short-term trades on the euro dollar or the euro yen in the same account, beautiful. Sometimes it's worth it to open up a separate account and use one account long-term, one account short-term, and just make it easy like that. But all kinds of trades are good. You have to know how to trade. Who says trading short-term is not good? They're dumb. It's a great point. It's not that short-term trading is not good. It's just, I don't think that my personal success has been as good short-term trading as it has been long-term trading. I think the charts are a little more accurate long-term. The trend lines, the Fibonacci levels are a little more accurate long-term. If you like short-term trading and you make money with it, God bless. All the power. If you're doing something and it's making money, don't stop. That's the number one rule. If you're a short-term trader and you're making money doing it, then all the power to you. You should continue to do that. But for those of you who maybe are new to the market, I have found that even after I've gone through bad times, I take a step back, I look at the long-term charts, and then slowly I move in from the long-term to the short-term time frame. For long-term trading, I like to use daily and weekly charts. That's holding position for several weeks, maybe several months. Medium-term or swing trading, I would use 1 hour or 4 hour charts. I would hold the trade, usually either a few hours up to a few days, maybe the most around a week. Short-term trades, I would use a 1 hour chart going down to a 15-minute chart. Aside from one particular strategy that I apply, I don't like to use anything less than 15-minute charts. Even the 15-minute charts can be a little bit erratic. But I think 1 hour charts give us a good example. Now, of course, if the market comes to a support or resistance level, we can always go to a 5-minute chart just to look for that extra source of confirmation, candlestick patterns. But I don't like to watch 5-minute charts day in and day out. I just like to go to the 5-minute charts when the market's at a very interesting level and I'm really trying to get a read on it. Have I backtested my strategies on demo account profitably consistently? It's very, very important to do so. Use demo accounts. You can lose $1 million gazillion dollars in a demo account and they'll always give you another one. Demo accounts and trade demo accounts for a few months because sometimes the market's range bound, sometimes it's trending. We may make a lot of money on a trending pair, but as soon as that pair slows down, things change. What are your thoughts on 1-minute charts confirmation? Jose, I've never personally used 1 hour chart, 1 minute charts. I've never used it. 5-minute charts, as is, I think is too short in time frame. Maybe a little bit more boring for some, but 1-minute charts, just especially in the foreign exchange market, there's no specialists, there's no volume. You know, it's a little bit more, we're using average prices. So again, for someone who uses 1-minute charts, I have heard of traders that have very good 1-minute chart strategies. If you're making money doing that, all the power to you. I suggest you continue to do so because there's nothing more important than than making money. To use multiple time frame confirmation medium-term trading? Yeah, absolutely. It's a great question. I will start with a daily chart. Daily chart, regardless of what strategy I'm using or what time frame, I always mark off long-term lines, long-term support and resistance lines. I always keep those on. My routine is I start with a daily or weekly chart. I mark off the long-term lines. But if I'm a short-term trader or a medium-term trader, I'll then go to a 4-hour chart, a 1 hour, maybe a 15-minute chart, and then I'll continue to mark off the more specific lines, time specific to now. But I always start with the daily charts. The difference is long-term traders, I only use daily charts. Pity no 1 second charts for scalpers. Boy, you're too much. What time is it? What's expected? Note the current time in the day's economic calendar. This goes without saying. The market tends to become active the first 2 to 3 hours of every day. 8 a.m. Eastern, the New York office is open. Japan opens at 7 p.m. Eastern, London 3 a.m. Eastern. Between 8 to around 11 a.m. Eastern. Right now, what time is it? 10:15 a.m. Eastern. The market tends to make higher highs and lower lows. Don't use a buy low, sell high approach at 8:35 in the morning. These, by the way, are when economic numbers are usually released. Russ Lander says, I'm a scalper. I think scalping is the best way to trade. And you know what? This is what makes the market. I love it. I love it. There's buyers and sellers. You're a buyer. I'm a seller. This is why markets move. The disagreement. It's the only industry where we can completely disagree and both be right. I love it. Russ Lander's a scalper. I love it. I love the scalpers. Believe me, back in the day, I did not want to look at a long-term chart. If you put a gun to my head, I did not want to look at long-term charts. I said, yeah, long-term chart's a 10-minute chart, right? How did the market react specifically to a recent news event? Non-farm payroll is better than expected. We expect the dollar to go up. If you were to look at a chart going back to this past month's non-farm payrolls, you'll notice the dollar went up, 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 up into the number. The non-farm payrolls was released in the U.S. better than expected. That actually marked the high of the dollar. If the news is better than expected and the market does not go up, it's a warning sign. Hey, buying the rumor, selling the news. If the market goes down, 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 then bad news is released, and then the market starts going up, then maybe it's baked into the cake, as they say. The bad news or good news is factored into the market already. This is a lesson I learned originally trading stocks. How many times do we see a stock reports better than expected earnings, and then it's down 10 cents for the day? That's a warning sign. Maybe everyone who bought already did buy. What kind of currency pair am I trading? Again, European currencies tend to move under the similar economic/geopolitical pressures, the euro, the pound, the Swiss. The commodity currencies are the Aussie, Kiwi, CAD, and also the Swissy. Note the dollar-yen relationship. What is the carry trade? It's the difference between interest rates in the two currencies within the pair. The Aussies and the Kiwis and the pounds have very high interests. The Japanese yen has 0.5% interest. Capital over the long term tends to flow into those currencies with higher interest rates and move out of those with lower interest rates. So barring any other situation, we tend to see Aussie yen and Kiwi yen and CAD yen and Swiss yen, all these currency pairs where the yen is the second currency with such small interest rate, the trends tend to develop in the direction of the higher interest rates. Always consider each currency in terms of its respective economy, central bank, the current level of interest rates, recent economic developments, etc. I want to pause for a moment. If anyone has any questions, FX Street, correct me if I'm wrong, I believe I have about 12 minutes left in this session. But with that said, if anybody has any questions, if there's anything specific that you'd like to go back over, I'll be more than happy to. And again, for those of you who are premium members, please stay tuned because we do have a very exciting premium session. And what we're going to do is we're going to take all this good information that we've gone through and we're going to apply it to the current market condition. We're not going to look at PowerPoint slides. What we're going to do is look at the charts and monetary statements and really get our hands dirty. High interest rates lead to uptrends. Is that what you said? Trader 15, great question. Okay. Generally speaking, capital tends to move into those currencies with higher rates and move out of those currencies with lower rates. We should also factor in the anticipation of higher and lower rates. So it's not necessarily, okay, if everything else is considered even, and let's say the central banks and the economic numbers, everything is put on hold, then I think capital will tend to go into the Aussie and the Kiwi and the pound and move out of the yen and move out of the dollar. Higher interest rates tend to attract the capital. Lower interest rates lose the capital. It's like a savings account. One offers a higher rate, the offer offers a lower rate. Capital moves into higher rates. But really, we have to consider the anticipation. What did the central bank say in their most recent monetary policy statements? What economic numbers have been released? What do we expect? If we are in the wrong position, how do we invert the situation? If we are in the wrong trade, well, I'll tell you this. The reason we get in the trade is the reason we get out of a trade. There's no such thing as a wrong trade if we thought it through. If you got in and you're short whatever XYZ currency pair because of the Bollinger Bands or the RSI or whatever it may be, and you did believe in that trade, then you're in the right trade. Now, will the market hit your stop order or your limit order first? That's left to be seen. But don't start second-guessing yourself. Make the decision, analyze the charts, look at the news, read these monetary policy statements, and then make our decision. But I would not necessarily want to second guess myself for any reason. I think it's very, very important that once we make a decision, we stick to our guns and take it from there. Now, I see there's other questions here. I don't have a lot of time left, but I promise I will get to them. I want to give you folks a quick link over here. This may be of some help. Okay. As far as the PowerPoint, FX Street is recording the session, and they will have, they also have the links to these PowerPoints as well. Can you explain buying the rumors, selling the news? Great question. What we can do is as follows. We simply wait for the news to be released, but notice, just simply notice, mark off, take note of how the market acted coming into this news. Non-farm payrolls is a great, look at the charts when you have a chance. Non-farm payrolls was the first Friday of the month. Look how the dollar rallied up, and then once the non-farm payrolls were released, the dollar spiked up, and that was the high. Basically, to explain buying the rumor, selling the news, if we expect a good number, everyone is going to buy. But once the good number is out, hey, what more good news is there? Now we have a room full of people who just bought the market, and these are all potential sellers. The traders a lot of times will buy before they expect a good number and sell once the number is released. What confirmation to use long-term charts, moving average trend, CCI, trend line break? I'll tell you, I use very, very simply, I like to use trend lines, Fibonacci on long-term charts. I like to keep it very, very simple. Shorter-term charts, I will use moving averages at times or Bollinger Bands or RSI, but longer-term charts, I like trend lines, support, resistance, Fibonacci. What platforms can run advanced charting? There's a ton of them. There's everything from TradeStation, if you like to program your own trades. There's MT4. If you have an account with a number of different, I would suggest, I'll tell you this, talk to your market maker, your broker, whether you trade through Forex.com or FXCM or Oanda, whoever it may be. A lot of these market makers are now offering really, really good charting packages. They're adding them all the time. If you have live accounts, sometimes even demo accounts, they'll give them to you. Talk to your market maker. They can give you, I know a lot of market makers now are offering MT4 charts. They're excellent. Those times of market openings you gave are the currency futures markets or what? Those are generally speaking. It's a great question on GRM. Those are, it's considered the general market times, 8 a.m. Eastern for the U.S., 7 p.m. Eastern for Japan, and 3 a.m. Eastern for the Euro session. By the way, this is a link. This will provide you with the most recent, you're so funny, it was like, the most recent monetary policy statements. If you have any questions, by the way, please do not hesitate. You can always visit my site, www.forexlounge.com. A couple quick seconds. We host almost 40 hours of live trading every week, where we actually, you hear my voice and my partner, we walk you through the trades. We created a trade messenger where it delivers live trading signals to you with programs we've made ourselves. If you have any questions, if you're interested, visit us there. I believe, FX, if I'm not mistaken, I'm taking a short recess, and we'll be back on not too long from now with another premium session, if I'm not mistaken at all. If anybody else has any questions, please don't hesitate to type them in at all. But really, stepping back with the fundamental analysis and with the simple chart reading, I know that you folks have heard this before, but keep it simple. Keep it simple. It's really, it's not, I don't think trading is supposed to be something that is very, very complicated, that is something that, you know, it's It's this, dilemma, this worldwide dilemma that we cannot kiss. That's exactly right. This dilemma that we cannot solve, this magical algorithm that only the MIT engineers can figure out, nobody else. Yeah, 1500 GMT, I see I'm scheduled for this next half. I think, I read a story once of a trader. It was in one of these books, Market Wizards or the New Market Wizards. And they basically, they told a story about a trader who was living on the top of a mountain in California. And he traded stocks, and he made millions and millions and millions of dollars. And he got his quotes from the newspaper. And the newspaper was delivered to the general store about 10 miles down the road. And by the time the newspaper, the New York Times or the Wall Street Journal, by the time the newspaper was delivered to the store, and by the time this trader got the paper, the quotes, I think, were like 10 days old or 5 days old. Now in the age of the internet and wireless trading, it seems that we cannot even leave our computer or our cell phone for a millisecond or we feel we're out of touch. But you know what? If we follow the rules and we write a trading plan, we test this trading plan on a demo account, we stick to our guns, we stick to our rules, I think you place the odds much, much more favorably in your favor. What were the platforms I missed? I'll talk to your broker. There's a ton of them, really. There's a website called 4x-Bastards.com. They have a rating system that allows you to see what other people have said. Maybe some other traders on this forum can recommend as well different platforms. But I would just go to Google, for lack of a better solution. I'd go to Google and type in foreign exchange or Forex, and you're going to get about 10,000 gazillion different hits. And just start going through, and you can call these. They're very, very helpful on the phone. They obviously want the business. Can you get us a trader plan, spreadsheet, or other thing like that? I do not have something printed up. I do have something actually. Visit our forum on forexlounge.com. We have a money management template that we have put together. And I believe I'm almost out of time. But if you have any questions, please do not hesitate to contact me through FX Street. For those of you who are premium traders, please stick around. We do have another presentation very, very shortly. What do you use for long-term trades again? Daily charts, weekly charts, trend lines, support resistance, and Fibonacci is what I use. I want to take this opportunity to thank everyone very, very much for joining us. It's been really a tremendous show. Thank you very much, FX Street, as well. Always a tremendous host. And for those of you premium members, again, please consult the calendar. I will be back on very, very shortly with another application, an advanced application of all this stuff, and much, much more. Thank you again, FX Street. I wish you all a profitable day, all profitable trades, and Sunday.